Year-to-date software stocks have been beaten down. So year-to-date, we see that the S&P 500 is down about 3.3%, and this IGV software index is down over 20%. So it's just been bad news for software stocks. They've been beaten down because of fears of AI, people thinking that AI is going to replace all the software that we use. If we go to the past 6 months, it's even worse. The S&P 500 is basically flat, and software stocks are down about 27%. But if we look in the past month, we see that things might be flipping, things might be changing. The S&P 500 is down 3.7%, while software stocks have recovered quite a bit, up 3.11%. If we zoom out to the past year, we see that that is in fact the case, that software stocks are still beaten down because at the end of last year and early part of this year, software stocks were just beaten down. It was the fear surrounding AI that really brought them down quite a bit. But we see that there was some outperformance there in the earlier part of the past 365 days. Now, if we zoom out to the past 5 years, we can really see the disparity between the S&P 500 and software stocks. And again, that comes mainly in the later part of last year, early part of this year. But the software stocks do seem to track and follow the S&P 500 quite well, but we see that there's a huge difference, up 68% in the S&P 500, while you're only up 26% in software stocks. However, the past 10 years, that changes. Even with the downturn in the software stocks, we do see that in the past 10 years, you were up 322% in software, where you're only up 221 in the S&P 500. So maybe this is a good buying opportunity to buy these software stocks when they're at dirt cheap prices. If you have conviction in these companies, and if you think that these AI fears are overblown, if you think that these companies can integrate AI into their business model, then perhaps these fears are overblown and we have some good buying opportunities in this space. In today's video, we're going to revisit some software companies that we've looked at in the past. We're going to look at their growth scores and their performance. We're not going to look at safety metrics in this video because most of these companies are high growth companies. They don't offer any dividend at all, or if they do offer a dividend, it's very, very tiny. So we're going to really focus on the growth of these companies because we want the growth to be the focus of these stocks in the coming months, in the coming years, to make sure that if we're buying these things at dirt cheap prices, if we have good conviction in them, we want to focus on that huge growth. Then we're going to look at the Interflame Finance intrinsic values of these companies, and we're going to compare those with the analyst expectations. And then finally, we're going to look at how we might invest a hypothetical $1,000 into these companies if we were interested here at Interflame Finance in doing so. So first up is Adobe, and Adobe has some fantastic numbers. We have a PEG ratio of 0.8, a forward PE of 9.8, and a 5-year forward PE at 7.6. So we're getting Adobe today at single-digit valuations. That is just unheard of for this company. Debt to equity looking solid at 0.6. We'd like that to be below 0.7. Return on equity and return on invested capital in the mid to low 50s to upper 50s. That's fantastic. Profit margins at a healthy 29.5%. So Adobe across the board is still just looking fantastic as a company. Next up, Salesforce, CRM. PEG ratio a little high at 1. We like that for especially growth companies to be below 1. Forward PE coming in at 13.9. Very low debt to equity. We like to see that. And nothing else too special about this company. They are expected to grow about 17.3% every year on their bottom line, every single year for the next 5 years. That gives them an 11.2 5-year forward PE for Salesforce. Microsoft, their very strong number here is their profit margins at 39%. PEG ratio a little high, but they've probably done a lot of their growing in the past 20 years. So we expect that to be a little higher for Microsoft. Forward PE coming in at 21.5, but a 5-year forward PE coming in even lower than Salesforce at 10.5. So that's very attractive and very interesting to us for Microsoft. And we see that that's not even one of the lower ones based on the fact that it's not in boldface type. So 7.6 for Adobe is one of the top 2 forward PEs on a 5-year basis. ServiceNow looking decent. Nothing stands out on this company. PEG ratio at 1.1, very low debt to equity at 0.2. That's nice to see. But we do see very nice 29.4% expected EPS growth every year for the next 5 years. And that gives them an 18.8 5-year forward PE. So still on the higher side when you compare it to these other companies that we've looked at so far. Now, Oracle comes in with a very strong 5-year forward PE at 7.6. Their revenue growth is expected to be 32% every year for the next 5 years. Return on equity, 58.1%. That's fantastic. That is second place only to Adobe. And PEG ratio under 1. That's nice. Forward PE 19.8. The one thing that does concern us about Oracle is their debt to equity coming in very high at 4.2, and the fact that their free cash flow yield is negative 5.6. We do not like to see that. Now, Palantir has a debt to equity of 0. They basically have no debt on the books when compared to their equity. Return on invested capital, a 147% return. That's great. Profit margins at 36%. Wonderful. Revenue growth and EPS growth expected every year for the next 5 years to be in the low 50s to mid 50s. That is wonderful. Their free cash flow yield leaves a little bit to be desired at 0.6%. And their valuations are starting to come down. This was a company that had PE ratios like in the several hundreds, 500, 600, and now their 5-year forward PE is coming in at a 26. So they are looking a little bit more reasonably valued now that they have established themselves. They are becoming more profitable, and that profit stream is steady, and they are expected to really get nice EPS growth in the next 5 years. Shopify is another company that has a debt to equity ratio of basically 0. Their PEG ratio is high, 1.8. We do like it to be below 2, but we really like it to be below 1 for high growth companies. So that is a little lofty. And also going back to Palantir real quick, that was a 2.0. Not too good to see that. EPS growth for Shopify, second place of all these companies, coming in at 34.5%. And everything else on this row for Shopify is looking just okay. Free cash flow yield at 1.2%, not good. 5-year forward PE, 29.9. I think, yep, that's the highest of the companies so far. So Shopify looking okay. The thing that they really have going for it is their low debt and their expected EPS growth. And finally, Workday has a PEG ratio of the lowest of all of these companies at 0.6, forward PE coming in at 11.6. That is second place for all of these 8 companies. Free cash flow yield coming in above 7%. We like to see that at 8.2%. So here are the 8 companies that we're going to look at today. And what we do on this channel is we score these companies based on these metrics from -10 to +10, with -10 being an absolute garbage company, +10 being a fantastic, perfectly run company. And so at the bottom today is Shopify. Yes, they have expected EPS growth of 34.5%, very strong every year for the next 5 years, but that's really the only thing that stands out. I mean, they also have very low debt to equity, but Shopify coming in at the very bottom at a 1.5. Now remember, 0 is neutral on this channel, so 0 is okay. So 1.5 is a little bit above that, but we like these scores to be higher. Palantir coming in with a 4.5. We like scores to be 5 or higher. Palantir is very close. They have great numbers across the board, but they also have some concerning numbers across the board, such as their high PEG ratio and their high forward PE. So something to consider for Palantir. Workday, the first company that we see coming in at a 5 for growth, and that is tied with Oracle, also at a 5. Salesforce comes in with a 5.5. ServiceNow comes in with a 6. Microsoft coming in with a 7. And the top of the leaderboard for growth companies in the software space is Adobe coming in with a very solid 7.5. So now let's take a look at how these companies have done. In the past week, Adobe has not been too great. It's down about 10%. In the past month, we were down 6.28%. Past 3 months, not looking any better, down 31% for Adobe. So this is that fear in the past few months on software stocks, really hitting Adobe hard. Past 6 months, you're down 33%. You can see that late last year, the fear started to come. And then late last year into the start of this year is when things really hit the fan and the stock price plummeted. Over the past year, you would be down 37% even on Adobe. The past 5 years, really not looking any better, down 44% for Adobe. So if you think of all the gains that the S&P 500 and the stock market and some fantastic companies have made in the past 5 years, and if you're in Adobe, you're down 44%, that is not looking too good. Now, Salesforce CRM is basically flat in the past week. In the past month, you would actually be up 3.8% for this company. Over the past 3 months, however, you would be down 24%. In the past 6 years, you're down 20%. If we zoom out to the past year, Salesforce was looking steady with a slight decrease in its stock price, and then all of a sudden, early this year, it hit the fan and it went down quite a bit. So you're seeing most of those losses occurring in the past 3 months. Over the past 5 years, you're still down overall in Salesforce about 7%. So again, in the past 5 years, you've lost 7% of your position, 7% of your value in this company. Not looking good on a long-term basis, but hopefully this is just a momentary dip, because if we zoom out to Salesforce over all time since about 2005, we see that we have a 4,400% increase. So if this growth trend continues for this company, if these AI fears are really overblown, then we might be getting Salesforce at a steal deal. Microsoft over the past week has been down 4%. Over the past month, we are down about 2.8%. In the past 3 months, Microsoft, one of the biggest, most successful companies of all time, is down 20%. In the past 6 months, we're down 24%. In the past year, we're only up 1.3%. So just thinking of the behemoth that Microsoft is, and only being up 1.3% in the past year when all their stocks have just done so well is quite alarming and possibly, once again, a great buying opportunity for us. Over the past 5 years, Microsoft is up about 68%, which is pretty much in line with the S&P 500. Now, next up on this list is ServiceNow. Over the past week, we are down 2%. Over the past month, ServiceNow is actually up 5%, so that's hopeful. However, in the past 3 months, ServiceNow is down 26%. In the past 6 months, we are down 40% for Salesforce. Over the past year, you have lost 32% of your value in this company. And over the past 5 years, we're actually up, which is kind of a trend bucker for these companies so far, up 22% in the past 5 years for ServiceNow. Next comes Oracle. We're looking at Oracle here down 6% in the past week. Over the past month, Oracle is down about 1.8%. Over the past 3 months, Oracle is down 14.8%. In the past half of a year, you've lost 48% of your value in Oracle. So that's almost a 50% drop. That's losing half your value in a company in a 6-month span. Over the past year, you're up just a tick at 2.6%. And over the past 5 years, Oracle is up 130% overall. So Oracle coming in with a lot of mixed results, up and down, up and down. But over the long term, we see that Oracle has grown. There was a huge spike, possibly overblown, in the middle to late part of last year, and it's come crashing back down to reality. The question is, have we reached the bottom? Is there value in Oracle? Next up is Palantir. Palantir basically flat over the past week. Over the past month, you have actually grown your position in Palantir 11%. Over the past 3 months, however, you are down about 19%. Over the past 6 months, you were down about 15%. In a year's time, Palantir has very much outperformed the market, up 80%. And we know that what Palantir does is what Palantir does. Over the past 5 years, you were up 530% in your position. So this is something that at Interflame Finance, we have bought early on. We bought it in the $6, $7, and $8 range. We've done quite well. We did trim our position, but we still have some shares of Palantir, hoping that the worst is behind us and that they will become a fantastic growth stock once again. Shopify has not had a good week. They are down 5.8%. Over the past month, they're basically flat, up 0.23%. Shopify is down 27% in the past 3 months. Shopify is also down 20% over the past half of a year. And over the past year, Shopify is actually up 30%, more or less. We see most of that loss coming in at the later part of last year, early part of this year, just like all these other software companies. And then over the past 5 years, Shopify, it's been a wild ride, but in 5 years' time, you're only up 9%. So a severe underperformance from the overall market. And then finally, Workday down 2.5% in the past week. Over the past month, Workday is down about 5.7%. In the past 3 months, we see that we are down 38%. Workday is down 42% over the past 6 months. Over the past year, most of those losses coming in recent months, down 46.6%. And then over the past 5 years, Workday, you are down half your value still in the past 5 years, more or less, down 46%. We see that we are approaching the bottom, if not crashed through that bottom that we were in during the 2022 crash. So we are maybe approaching lows again. Maybe there's some support there, but in the past 5 years, you are still down 46% in the software company. So we have scored these companies. We know what companies are fantastic, which are okay, and we now know how they performed in the past few months and in the past 5 years. So it's not just enough to get great quality companies. We want to make sure that we get them at great prices. And so what I have here is the intrinsic value calculator for Adobe. The intrinsic value calculations are absolutely crucial, essential things that every investor needs. So if you go to the description of this video, you will see 4 different intrinsic value calculators that we've built out on this channel, step-by-step tutorials to show you how to do it as well. There's the PE ratios model, the dividend discount model, there's a discounted cash flow model, and Graham's valuation. So we are going to do 3 of the 4 for these companies, since most don't offer any dividend at all, and if they do, it's very small. So we do the average of these 3, and we get what's called the intrinsic value, and that is what we feel the company is actually worth per share. We compare that to the price and see, is the price significantly lower than the intrinsic value? If it is, we compute the margin of safety, and we just basically see how much of a discount we're getting on these companies. So Links in the description below. Check out those videos. Build out your own intrinsic value calculators yourselves so you can do this. Absolutely essential for any investor. Now, Shopify had the lowest growth score at 1.5. I did compute safety scores for these companies, but we're not too interested in those in this video today. I will show them if you are interested, but you see the weighting here. We are putting all the weight into the growth scores today, 0% into the safety scores. So this average score is just a reflection of what the growth score is. So for Shopify, they had the lowest average score at 1.5. They're currently trading for $122 per share, and we think that they should be worth $75 per share. So that actually means that you're paying a 63% premium on Shopify. So we think that Shopify should be trading for $75 per share. The analysts kind of disagree. The analysts are saying that there's an average increase in the stock price in the next year of about $165. That would be a 34 to 35% increase in the stock price for Shopify. The most bullish analyst is coming in with a $200 price target. That would be a 64% increase in Shopify. And there is a bear or two out there saying that Shopify will go down 13.7%, low estimate coming in at $105 per share. Overall sentiment is a buy for Shopify. According to Wall Street, there are 7 analysts that say strong buy, 19 that say buy, 8 analysts say hold. Nobody's in the sell or strong sell category for Shopify. Now, before we move on to the other 7 companies, if you're getting anything out of this video, please like it. It really helps out the channel. And if you want to keep coming back for more intrinsic value calculations and stock analysis, please subscribe to the channel so you don't miss a thing. Palantir coming in next with a score of 4.5. They're currently trading for $151 per share. We think that they should be trading more like in the 120s. And so that is a 26% premium for Palantir. Not interested in that company based on those metrics. And if we look at the average analyst expectation, they are more bullish. They're saying between a $196 and $200 price target over the next year. That would be in the high 20 to 30% increase range. High estimate coming in at 260, so that would be a 71% increase in the stock price. But again, Palantir has its bears, as it's always had. Low estimate coming in at $50 per share, down 67%. So mixed all across the board. Let us know in the comments below. What do you think of Palantir as a company? What do you think of them as a stock? Now, the overall consensus for Palantir on Wall Street is a buy. There are 7 people that say strong buy. There are 5 analysts that say buy. 8 analysts are saying hold. 1 says sell, and nobody says strong sell for Palantir. Oracle's the first company that hits that 5 mark that we like for the score, but they do have a safety score of -1. But again, we're not looking at safety scores in this video. And they're also the first company with a positive margin of safety. They're currently trading for 154. We think that Oracle, based on their growth metrics, should be trading for $280 per share. So that is quite the increase, and that is quite the margin of safety for that company. And Wall Street seems to agree. Average price coming in between 250 and 267. That is a growth in the stock price over the next year of between 62 and 74%. The highest analyst coming in at a $400 price target. That is more than doubling your position in Oracle. And even the low estimate says that there's still a 3.9% increase ahead for Oracle, $160 price target. So overall consensus on Wall Street is buy. 11 say strong buy, 17 say buy, 5 say hold, nobody says sell, and there is 1 strong sell, which is interesting because everybody thinks that there's an increase in the stock price. So do with that information what you will. Oracle stock, overall consensus is a buy, and we do tend to agree with Wall Street that there is room for growth in this company, in their stock price over the next year. Now, Workday coming in with an average score also of 5. They are tied with Oracle. Margin of safety, 23%, so not as attractive of a price for Workday. And we can see that analysts think that there's about a 50% increase in Workday as a company. Over the next year, the high analyst comes in with a more than doubling of the stock price at 145% increase. They think that that should be trading for $328 within this year. However, there's somebody that says that Workday is actually going to go down to $125 per share. That would be a 6.7% decrease in the stock price. Overall consensus is buy. There are 9 analysts that say that Workday is a strong buy, 10 say buy, 14 say hold, and nobody's in the sell or strong sell category for Workday. Salesforce also had a 23% margin of safety, but a slightly higher score at 5.5. Our estimate of 255 is kind of in line with what Wall Street thinks. Wall Street is a little bit more optimistic at a 280 price target on average. The high analysts coming in at a doubling of the stock price, more than doubling at $405 per share. That would be a 106% increase in the stock price. and the low estimate saying it's basically trading for fair value. Maybe it's a little elevated. It should come down about 1.3% over the next year. So overall consensus for Salesforce is also a buy, with 12 analysts saying strong buy, 14 saying buy, 9 saying hold, 1 saying sell, nobody saying strong sell for Salesforce. So we tend to agree with Wall Street on this company. We think that there is room for growth in the 30 to 40% range. So let us know in the comments what you think about Salesforce. ServiceNow coming in with a score of 6, and they are trading, in our opinion, for basically fair value. They are trading for $113 per share. We think that they should be trading for $115. That is only a 1% margin of safety. We like margins of safety to be in the 15 to 20% range at least. So not a lot of room for error when it comes to ServiceNow. So probably not something that we were too interested in, but our $115 price target is actually in line with the most bearish analysts on Wall Street. Overall, ServiceNow, people are saying that it should be trading for like in the low 200s. That would be between a 75 and 78% increase in the stock price over the next year. So we are on the bearish side when it comes to ServiceNow based on their growth metrics. The high analysts coming in with a more than doubling of their stock price at $260 per share. That would be a 129% increase for ServiceNow. Overall consensus, again, we disagree with them when it comes to this company. Strong buy overall. There are 13 analysts that say strong buy, 15 are saying buy, 2 say hold, 1 says sell, nobody's saying strong sell for ServiceNow. So let us know in the comments below. What do you think? Do you agree with us? Or are you on the more bearish side when it comes to ServiceNow? Or do you see growth in the future? Are you more optimistic about this company? Now, by far the largest company on this list is Microsoft. Their score was 7, margin of safety 15%. Their current stock price is $389. We think that they should be trading in the mid 400s at $460, and that is on the more bearish side. It's in the range of analysts. Analysts say it's between 392 and 675. But the average consensus is it should be trading for about $600 per share. That's about a 54% increase in the stock price for Microsoft in the next year. High estimate coming in at 675. That would be a 73% increase in the stock price. And the lowest analyst is saying that Microsoft is actually trading for fair value, not a lot of room for growth in the next year. Now, the overall consensus is strong buy for Microsoft. 12 analysts are in that camp saying strong buy, 18 are saying buy, 3 analysts are saying hold for Microsoft, and nobody's in the sell or strong sell category for Microsoft. And finally, Adobe. Adobe with the strongest score of 7.5. Their margin of safety is 37%. That's nice to see. They're currently trading for $247. We think that they should be trading for $390. And that $390 price target is a little higher than the average consensus on Wall Street. Wall Street saying it's somewhere between a 33 and 42% growth in the next year. And the highest analyst coming in with a $500 price target that is basically doubling the current stock price, 102% increase. And there are bears out there for Adobe still saying that it's going to probably drop about 11% in the next year. So the overall consensus, therefore, is a hold for Adobe, according to analysts. 3 are in the strong buy camp, 7 are saying buy, 14 say hold, 1 analyst says sell, and there are actually 2 analysts that are saying that Adobe is a strong sell. So mixed reactions, mixed results amongst Wall Street, and when we compare it to our numbers as well. Let us know in the comments, what do you think about our highest scoring company, Adobe? Do you think it should be trading for in the 390 range, or are you on the bearish side or the much more bullish side? So to give you an idea of what we do at Interflame Finance, we take both their scores and their intrinsic values into consideration. And so we're going to look at now how we might invest a hypothetical $1,000 if we wanted to put $1,000 into these 8 companies. This is a great place to remind you that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell anything in your personal portfolios. Your investment decisions are a very personal thing, and you should take caution and extreme care in deciding what you do with your hard-earned money. So always do your own research, always do your own diligence when it comes to investing your money. So no surprise when it comes to Shopify, we would not put anything into Shopify today. They have a negative margin of safety, meaning that you're actually paying a premium for this company, and they have the lowest score of these 8 companies. So not interested in buying Shopify today. Same goes for Palantir. If these prices come down a little bit, if their score improves a bit, maybe we would consider going back into buying Palantir once again, but we're just going to hold the shares that we have. Now, what we have here are the buy and the buy heavy prices for these companies. So based on the intrinsic value, if you also believe that Shopify Shopify should be trading for $75 per share, and you would like a 15% discount, then you would buy Shopify at $64 per share. And if you want a 35% margin of safety, if you want a deep, deep discount for these companies, you would look in the buy heavy category, and you would see that Shopify is a buy heavy at $49 per share. Palantir, if it ever hits 78 or lower, that would be a buy heavy at Interflame Finance. So the first company that we would consider buying is Oracle. Oracle, with their score of 5, which is the minimum of what we like to look at for companies. We want to make sure that we're getting quality companies. Well, also, with their very strong margin of safety of 45%, that is a $262 purchase out of this $1,000. So we would put over a quarter of our money into Oracle. They are at the not just buy, but the buy heavy mark for this company. $280 price target is the intrinsic value. And so we would buy anything under 238 if we wanted a 15% discount, and we would buy heavy anything under 182, and the current stock price of 154 fits the bill for both those categories. Next up is Workday. We would put about 13.5% of our money into Workday. They also have a score of 5, but not as much of a margin of safety, just 23%. So we would be a little bit more cautious with Workday and only put about half the money that we would put into Oracle. It is a buy at 149 with that 15% discount. Not at the buy heavy mark yet. If it got down to 114 or lower, we would consider buying it much more heavily. Salesforce, with a $150 investment of our $1,000, that's about 15%. Salesforce had a higher score of 5.5 and a margin of safety also 23%. It is a buy at 217 or lower. It's currently trading for 195. If it ever dipped down to the 166 mark, we would buy much more heavily. ServiceNow, basically trading for fair value. So it's a solid company coming with a 6 on our score. Maybe a little bit of room for growth, but probably not much. And so, out of $1,000, we're not even putting 1% in. We're not even putting in 0.1%. We're only putting in $9 into ServiceNow. So it just comes out in the numbers that way. It's something that we would buy at $98 per share, like a significant purchase, and then we would buy much more heavily if ServiceNow ever got to the $75 mark or lower. Microsoft would get 12.5% of our money. They are a buy because they are under 391. They're trading just under that at 389. Solid company. I mean, it's Microsoft. Their average score is 7. Their margin of safety of 15%. I mean, this might be one of the cheapest valuations that we see for Microsoft for quite some time. So Microsoft would get about $125 of our $1,000. And finally, Adobe. Now, this was the company that had some very strongly mixed reactions on Wall Street. We have them with the highest average score at a 7.5. The current margin of safety is 37%. So their current stock price is $247. We think they should be trading for $390. That is both under the buy and the buy heavy marks. And so actually, now that we're recording this while the market is open, we see that these numbers have changed a little tiny bit. Adobe is now a $321 investment into our portfolio. So again, this is not something that we're going to do, but we're just showing you how we think at Interflame Finance. If we wanted to invest $1,000 into these companies, this is how we would allocate that capital. Let us know in the comments what you think about these companies. Are you buying, holding, or selling any of them in your personal portfolios? I really appreciate you watching this video. Please remember to like if you got anything out of this video. Consider subscribing so you can keep coming back for more Interflame Finance intrinsic values and growth and safety scores. Tell your friends and tell your family and tell your mother-in-law all about the Interflame Finance methodology. And we want to grow out this channel. We love serving you. We love answering your questions. We love hearing from you. So keep coming back for more. We appreciate you being here, and we'll see you in the next video.